Looking back to mid-2015, 12 months ago now, I think most investors would have been very confident that the Federal Reserve in the US would have been raising rates a number of times in the next 12 months. That would have had strong implications for the currencies to be invested in. So mainly the US dollar would be a recipient of higher returns, and perhaps the Australian dollar would have fallen more in that environment. Importantly as well, most investors thought that staying away from the emerging market equities, countries and currencies was very important in that environment. Well, as always, the expectations of the consensus opinion didn't come to fruition. We had probably 3 major market shocks in the last 12 months. I'm not sure that anyone could have predicted, certainly not all 3. The first one was back in August 2015, when the Chinese central bank unexpectedly produced a managed depreciation of the Chinese currency, really starting to give investors a feeling that Chinese growth was slowing much more rapidly than expected. In this environment, both risk assets, equities, and currencies sold off rapidly, but then actually quite responded quickly to bounce back by the end of September. Early in 2016, starting from the first week of the year, it was in some cases an unhappy new year. By mid-February, oil had fallen to below $30 a barrel. This was really kind of the end of the commodity cycle that had been started in the iron ore markets in Australia in 2014. Once again, markets suffered, both currencies, both high yield assets and equities, but bounced back again quite rapidly by the end of March. And lastly, we had the Brexit event at the end of June, when the Leave campaign won the British referendum to potentially leave the European Union in the near-term future. This again rattled markets, and particularly currencies. As you know, the pound sterling fell by over 15% in 2 weeks, and some of the financials, the banks in the UK and Europe, have fallen very significantly. But in general, again, while most markets were rattled quite severely in the first week, most markets have bounced back in this first period of July. When you're in this environment where global growth is just not achieving expectations, you're always going to have certain events that are unpredicted, basically rattle markets and cause volatility and cause buying opportunities. In this environment, we hold cash that buffers us in uncertain times and provides us with the liquidity to buy cheap assets when these events happen. But in general, rather than trying to predict the outcome of events like Brexit or what the price of oil is going to be in 2 years' time, we focus on valuation-driven asset allocation. That basically means looking forward into the future, which assets are cheap compared to their historical measures, and therefore where do we skew our portfolio? We skew towards the cheaper parts of the asset allocation environment. And right now we're focusing on the emerging markets. We think that the fears are overblown about the potential for a Federal Reserve rate rise causing emerging market crises like in the past. And we think both emerging market equities, currency and emerging market bonds are great places to be in terms of producing competitive returns and maintaining your capital in this environment. Also thinking about currencies very significantly and being in the right currency, i.e. the yen and not the pound in the last 1 month, this environment is very important. And lastly, for Australian investors who've been used to investing in the local share market, the last 12 months has been particularly difficult, where the big resources companies and the banks have been under pressure to cut dividends. We expect going forward that investing in a diversified portfolio, not just focused on those resources and banks companies, is the best place to maintain your returns going forward.